Everybody, this is Jim Bear from RJO Futures. Happy New Year. Market's a mess this morning. Stock market's a mess on a worldwide basis, led by China, down roughly 7%. Stock indexes in Europe down 3.5. In the U.S., 2.5. Why? Another weak manufacturing number out of the Chinese. This is really nothing new. This is what's been happening. I think a lot of it has to do with the calendar again. I mean, there is some profit taking in a few stocks that have kept the U.S. market higher to unchanged for the year, whereas most stocks are down considerably. Anyways, all this is kind of good news for notes and bonds. Indeed, bonds were up 1.5 to begin the year. The notes were up over a point. We've fallen off just a little bit here, but the sentiment swings in stocks have been the story in notes and bonds for the last 6 months. It looks like that's going to continue. Just recapping last year, the yields ended up higher, but like marginally higher, like 4 or 5 basis points higher. Yield still carried the day. The bondholders on a year-end basis did as well. Or did actually better than the stock market, except for the NASDAQ, except for the highest flyers. Anyways, with this risk off to begin the new year, I'd expect the notes and bonds to, possibly retest the extremes. The downside extreme in the notes has been 190 for months. Is there a possibility of taking that out in the first few months of the year? Well, I mean, if we do have a longer term stock index top, that's certainly the case. I mean, manufacturing on a worldwide basis is in trouble. I don't know what the Fed sees. I mean, some of these people are talking about 3-4 rate increases for 2016. With manufacturing reeling like this, not just in China, but in the U.S. too, things have softened up because the dollar has made U.S. exports look expensive on a worldwide basis, and of course the oil patch is a wreck, and budgets are still being cut back by the capital expenditure rather is still being cut back in a serious way by the oil industry, and there's no other industry to really pick up that slack at the moment. I mean, obviously automobiles have been strong, and housing is better relative to the last few years, but still considerably under last cycle highs. And so, I mean, at the moment we're in a bit of a quagmire confidence-wise about things, and this is typically always good for notes and bonds. So that's it for now. I mean, as far as reports this week, here we are. The start of a new month, not just the start of the new year, but the new month, of course, which means we have unemployment on Friday. There'll be guesses by the various ADP and Challenger Wednesday and Thursday this week. There are a number of Fed speakers. It'll be interesting to see if any of them, what their comments are about the Chinese market, given this kind of meltdown to begin the year. Any mention of that, I would think would be somewhat supportive for the notes and bonds also. Our own factory orders come out Wednesday. Non-manufacturing ISM number, which is often important, comes out Wednesday too. But the focus is really on manufacturing, which is weak. Expect the notes and bonds to do well in a near-term basis. I've reached at 800-500-2461. Please give me a ring. Futures and options on futures may involve substantial risk and may not be suitable for all investors.